All right, we're going to talk about the Doom principle. Except this time, unlike the other video about the Doom principle, we're going to be talking about the FIFO compliant version. FIFO stands for first in, first out, meaning you have to exit the first trade that you place before you can exit the next trade that you placed. For the most part, the United States is under the FIFO compliant or compliance rules, etc. And in some ways, you can get around that, I suppose. Like with Owanda, you can close out a different trade first, like one of the other. You can close out the second trade first if you want. But for all intents and purposes, we're going to stick with FIFO compliance on this particular Doom principle. It's going to be a little bit different than the other one, like than the original. But if you want to see more information about how it was created or why it's named the Doom principle, then visit the other lesson about the Doom principle, and I'll put a link for that inside of the course lesson video thing. Anyways, the Doom principle is not just a money management technique, it is also a profit optimization strategy, meaning we want to get as much profit out of each trade as possible, or at least each set of trades. All right, now this is going to start to make more sense the further we get into it. So if things seem a little bit confusing, don't rewind the video. Just keep watching all the way through. And if you have to watch the whole video a couple times, then I apologize. You had to spend so much time with me. Okay, what is the Doom principle? To understand the Doom principle, let's consider this situation. You're in a great trade, and you want to stay in that great trade so you can get some more profit, but you don't know when you should get out. There's been several times, for me at least, and possibly for you and other traders, where you stay in a trade too long and you end up coming back around and going and breaking even, or potentially even losing money. So you see your trade going for you and it's making a bunch of money, but then it's just so disheartening whenever your trade comes back around and then you end up losing money. That really, really sucks. Okay, and that's where the Doom principle comes in. This profit maximization strategy is designed to take some of that profit off the table quickly, tuck it away a little bit at a time, and reduce significantly, if not entirely, the risk of getting out at a loss if the market turns back around. Now, this is all about if your trade is going into profit. Now, if your trade immediately turns around, like you place a trade and then it immediately goes against you, then that's where some of the other money management strategies come into play. Like when we take a second trade in the same direction with a larger trade size, which is what the majority of the robots will do. But we aren't talking about that. We're talking about the Doom principle, which is profit maximization. So as your first trade is going into profit, maximizing that particular trade or set of trades. Okay, now how does this work? We're going to take the same situation we had before, like what we were just talking about, where our trade is going profitable and is pretty awesome, but we don't know where to get out. Once we reach a certain amount of profit, we would close half the position. Then we would move to break even of profit, which is another concept that we're going to talk about, and take an additional trade at a different trade size or same trade size, whatever it is you decide you want to do, whatever you feel is best. All right, so here's what closing half a position would look like. Let's say our initial trade size is 4 micro lots, and we are currently $20 in profit. The broker automatically performs the tasks for you that's necessary to close half a position. So whenever you go to close half a position, it's actually pretty simple, especially if you're doing it robotically. The robots that we're covering that have the Doom principle in them do this automatically. But if you are doing it manually, then it's just as simple as modifying the trade and then closing out half of the lot size. But when you close out half of the lot size, so we close out 2 micro lots, then we also close out $10 of profit, because we're at $20 of profit. at 4 microlots. So when we close out half the trade, we close half the profit. This $10 of profit that we close out is added to our balance, meaning it is realized profit. So this $10 isn't going away anymore. It's in our account. Awesome. Now your trade is still open, but it's only 2 microlots. And you're positive $10 because you closed half the trade. Your risk has been reduced, and no matter what, you have made $10 of profit. All right, now you open an additional trade in the same direction as the first. So right when you close out that 2 microlots of the first trade, you place another trade. And let's say the first trade was a buy, and it was 4 microlots. Our new trade could be whatever size we want, but it would be a buy trade, and we can make it like 4 microlots as well. So here's the complicated part. It's not really complicated, but it's a little bit difficult to understand at first. You now set a mental stop, or you can let the robot do it for you, where if your profit goes back down to $0, you exit all the trades. So let's say we have our 4 microlot new trade, and we have 2 microlots of the original trade. And now let's say the 2 microlots of the original trade is positive $10 or positive $5 or whatever. And the new trade, the 4 microlot new trade, is negative by the same amount. So negative $10 or negative $5. Then that would, the cumulative total profit that you would have between those 2 trades would be $0. And you would exit both of them. Now, let's say you have more than 2 trades open. It's the same concept. If you add up the cumulative total profit of all of those trades and it equals 0 or less than 0, hopefully not less than 0, but if it equals 0, then you close out all of the trades and we start back at the beginning. But no matter what, you still have that $10 of profit that we closed out already. So a normal break-even stop would be when the market goes back down to the original entry price. But doing that would actually mean losing money at this point. After you've opened that second trade, if it goes against you all the way down to the original entry price of the original trade, then you're actually losing money at that point. It's not break even anymore. You'd actually lose some of that money that you already got. We don't want to lose any of the money that we already got. It's the whole point behind the Doom principle, is not losing the money that we already gained. So we don't want to lose it. We want to make sure that no matter what, we have that $10 of profit we already closed. So after we have placed the second trade, the 4 microlot trade, we have a 2 microlot trade open, a 4 microlot trade open. Now we repeat the process. If we reach a predetermined amount of profit, we do the same thing. So let's say the predetermined amount of profit is $12. The initial profit that we looked for was $20 to start this entire chain of events. But now we look for $12. Once the cumulative total profit for those 2 trades reaches $12, we close out half the position of the first trade. Now, the original Doom principle is closing out half of all of the open trades, but you can't do that when you are trying to be FIFO compliant. So for FIFO compliance, we only close out half the position of the first trade. And here's what that would look like. The original trade was down to 2 microlots from the first closure, and the second trade is 4 microlots. So we're still looking at the first 2 trades. Closing half the first position would take the trade down to, 1 microlot, and the second trade would remain at 4 microlots. So half of 2 microlots is 1 microlot. And then we leave the 4 microlots as it is, because this trade was placed second, so we can't close it out because we're still trying to be FIFO compliant, first in, first out compliant. Now we have a 1 microlot trade, a 4 microlot trade, and we tucked away $6 more of profit. That brings our total realized profit to positive $16. Now, this isn't exact because we're talking about cumulative total profit between the 2 trades. So it's not actually $6. It's probably something more like $5 or, I don't know, $5.50 or something. But regardless, we're at about $16. Now we place another trade. We place another trade in the same direction as the first two, and the size would be the same size as the second trade was. So it's 4 microlots. With our 3 trades open now, which is 1 microlot, 4 microlots, 4 microlots, we wait and watch for the cumulative profit to equal $12 again. Then we close the first trade completely. Why do we close the first trade completely? Because you can't split 1 microlot in half. Unless you have some broker that allows you to do I don't know, ultra micro? I have no idea what that would be called. But unless you have a broker that allows you to go down to 0.001, you can't split a microlot in half. Nor do we really want to. So we just simply close the first trade out altogether. And then we close out half of the next trade. So we close out the full first trade, which is down to 1 microlot. And then we close half of this second trade here. So now that brings our trades to a 2 microlot trade, which was the second one, and a 4 microlot trade, which was the third one. Once again, we have taken $6 profit off the table. And again, it's not exactly $6. It's less than that because we're talking about a cumulative total of all 3 of these trades. But regardless, we take $6 off the table, bringing the total realized profit to $22. Then we take another trade in the same direction at 4 microlots. So then we have a 2 microlot trade, a 4 microlot trade, and then another 4 microlot trade. Now, when does this all end? Basically, it doesn't end until profit reaches $0. And let me explain that. It has to do with that break-even principle that we just talked about, where you've gone so far that all of your trades have been opening up and closing and opening and closing, but then eventually the market turns back around, possibly, and starts to go the other direction. The most recent trades start to go negative, whereas the older trades are still positive. So once the negative and the positive trades cancel each other out to where there is $0 of unrealized cumulative profit, all trades are closed. Now remember, if this were to happen at this point that we were talking about right here with the 2 microlots, the 4 microlots, and the 4 microlots, if this were to have happened right now, we still had $22 of profit that has been taken off of the table. As in, it's been closed out, it's in our account balance, and we don't have to worry about losing any of the 22, and all 3 of these trades just equal out to 0. Now, this helps because it is keeping your risk minimal. It takes small amounts of profit off the table to keep it safe and allows the market to continue moving while adding more trades in that direction. So that way you can take profit on more of a significant move than if you were just trying to guess at when you should close out. All right. Now let's see how this works in some historical examples. All right. I'm going to change this to 2017. That way it can go a little bit quicker, and we're going to go to visual mode so we can see what's going on. Okay. Now, if you remember, now these all have to do with the moving average divergence robot, so I'm not going to cover these at the moment. We're going to go down here to doom lots, which each of the additional trades that you're adding will be 4 microlots, or whatever it is you set this to. Beginning doom profit, that means once the total profit of this one trade, this initial trade, the 4 microlots, once that equals $10, it cuts this trade in half, takes $5 off the table, places another trade at this lot size, and then starts looking for $25 of profit. Once it reaches $25 of profit, it cuts that in half, so it takes $12.50 or whatever off the table. This trade becomes 0.01 because it had been cut in half already, and this trade stays the same. Then again, if it reaches $25 profit, take half off the table, and then this one is closed out altogether because it's been cut in half twice already. And then this one is cut in half. And we place another trade. Max trades, you'll probably never have to deal with this in the FIFO compliant version. But just in case, if you don't want it to place at the exact same time any more than like 10 trades, if you don't want any more than 10 trades to be open at a time, this needs to be set to 10 or 15 or 30 or whatever it is you want to keep it down to. So press OK. And let's just watch this thing go just a little bit. That way we can see how it works. Okay. We placed an initial buy trade here, 4 micro lots. And it figures the first trade set's not that fantastic. So we actually place the second trade. This is according to the moving average divergence robot rules. Has nothing to do with the Doom principle. This is just the moving average divergence robot rules. So right now we are actually looking for the profit trade 2, which I set to $4 for this particular robot. And so there it took profit. So there was a first trade, second trade, it took profit right there for $4. $4.16 actually. And now we place another buy trade. Ooh, there we go. Now we can see the Doom principle in action. We placed a buy trade. It reached $10 of profit, which is the Doom principle beginning thing. And it closed out half of the trade, half of this initial trade. So it took $5 of profit. You see right there. And it cut this first trade down to only 2 micro lots. And then it placed a 4 micro lot trade. Then we go a little bit further up here to this one, and we see down here it closed out half of the trade again, so now it's down to 1 micro lot, and we place another 4 micro lot trade. So then it goes a little bit further, and then it closes out the $6.56. It closed out the original buy trade all together, and then placed another 4 micro lot trade. And then it cut this second one in half. So this one up here that you see. So we had the 4 micro lot cut in half and then opened. And then here's the 4 micro lot trade. That one was cut in half down here. So it closed out 2 micro lots and then it placed another 4 micro lot trade. Now, all the trades, all these trades that are still open, came back down just a little bit and closed out at $0 profit. So 684 plus 24 is 708. And then 460 plus 260 is 720. So it turned out to be just about 0. Sweet. Maybe a little bit less than 0. Looks like 12 cents less than 0. So we actually lost 12 cents on that one. Big time. And the reason why we lost 12 cents, let me just cover this really quick, is that it is extraordinarily difficult for anyone or any robot to close out a set of trades at exactly 0, depending on how fast the market is moving or a whole slew of other issues that can arise. You probably won't see it very often close out at exactly 0. It'll be usually something like negative 10 cents or negative 20 cents. And in very, very extreme circumstances, you might see like negative $1 or something. And that's just if the market's moving really quickly or you have a lot of trades open. But let's go ahead and continue just a little bit further. And we see a whole nother spider web open up here. Man, that's a cool looking one. Okay, so let's go down. We open up a 4 micro lot trade right here. We got down to $10 of profit right here, so it closed out half of the trade, which means we got $5 of profit right there. And then you see that we've got the two micro lots still open, and we opened up a new 4 micro lot trade. And then we come all the way down here to this point, where we close out half of the original trade again, 585. So we're left with 1 micro lot trade. and we open another 4 microlot trade. Then we go down just a little bit further. We close out the 1 microlot altogether. So the initial trade's completely closed out. And we open a new 4 microlot trade. And we immediately close half of that first Doom trade that was all the way up here. So we closed out half of this one for $9.06. So we're left with a 2 microlot trade, and then we open another 4 microlot trade. And then finally, it comes back up just a little bit, and we exit at 0 again. This time, this time only minus 6 cents. Look at that one. Yeah. Not too much slippage that time. All right, let's just watch for one more example real quick, which was right there and then right there even. Okay, so we closed out half of the first trade right here and opened another 4 microlot trade, but it immediately went to 0. So we made $5 on that one. Hopefully that makes sense. Let me go to it really quick. That way we can see what happened. Place the first trade here. And then it made $10 down here. So we cut it in half. And we took that $5 and just set it aside. And we placed a 4 microlot trade. But then it immediately came back up again. So it closed out at, looks like negative 2 cents. Big loss there, 2 cents. It's a travesty. Okay, and then the same thing happened here. We got this first trade, came down, closed out half of that position. See, sometimes it works for us too. $5.26 because of the slippage of this huge, huge candle. So we still have a 2 microlot trade, and we open a 4 microlot trade, and almost immediately, because of the size of this freaking candle, it went back up, and we closed out at 0, which actually that 0 is about negative 10 cents. But still, on this trade, instead of watching it go down and then watching it come back up and then just getting all nervous and horrible feeling, we got $5 of profit out of it and called it a day. All right, let's stop the test, and we're gonna go back down. We're gonna go to 2016, and we're gonna take it out of visual mode so we can just see how this looks after 2 years of trading. It takes a little bit of time, so be patient with me as we watch this little green bar go. We'll actually watch the graph because it's more fun. And this looks like a really strange equity curve, but that's because we have a lot of trades being opened at the same time, and we're taking half profit on them as we go along. So the equity curve looks kind of funky, where the green and the blue are just kind of swirling around each other, but the general direction is up, and that's really, really what we want to see. General direction of up. Oh, we're not even halfway yet. Oh. But hey, we've made $620 so far. 680. Ooh, 740. Holy crap. That was a jump. And we're not even halfway. 770. Still going. This here was a gap where the market gapped. So whenever it tried to get out at a lot or at 0, the market actually gapped way down. So that's why we ended up losing a few dollars instead of getting out at 0. But then I guess we had the same effect here where it gapped way up. Must have closed out of just about everything. That's pretty cool. Okay, we're done. Let's see. Our drawdown was $582, and we made $1,862. So we drew down by 5.6% to make 18.6%. I'd say that's a pretty good trade-off. That is the Doom principle, and this is the Doom principle for FIFO regulated areas, or FIFO regulated brokers, or FIFO regulated accounts, or whatever you want to call it. If you are not under FIFO regulation, you can still use this robot, or you can download the original version of the Doom moving average divergence robot from the other lesson. Thanks for watching.